So we can also find more information on probabilities for our returns of something like the S&P 500 by using any old online normal density function calculator, or we could also use Excel's norm inverse function. So for example, we could find for the S&P 500 that we have about a 5% probability, which would be once in every 20 years, that the S&P 500 or the SPY returns will be minus 34% or worse. Okay, that's pretty scary, right? That's losing an awful lot if you've got your whole retirement baked into that, or your child's college education baked into that. That could be really bad news. So let's see how I got to that using the norm inverse function in Excel. So I'm going to say norm inv, and whoops, I need to make it the real deal here. Hold on just a second. There we go. That's what I'm looking for. The little helper down here. So the norm inverse function gives me, if I put in the probability I'm interested in, so that's 5%, and our mean return for the SPY is 8%, and the standard deviation is 0.25. Okay, and there is our, in this case, 33% return. So not quite 34, 33% return. So the norm inverse function gives us what's our return going to be if we're thinking that we want a 1 in 20 year probability of that return or worse. So this is actually important. This criteria, what we just did, where we're asking, what is the downside range of returns that we expect 5% of the time? When we ask this question, this is called the value at risk criteria. This is a very important criteria. Clearly, I can't ask you to compute it on exams because we do need something like this to compute it, but I do need you to understand the concepts. It is important because it's used by banks, the Fed, smart fund managers. It's used all over the place. Jamie Dimon at JP Morgan Chase gets a 20-page value at risk report on his desk every day, looking at the value at risk of various investments and strategies used by JP Morgan Chase. And I do have another article I've put up in readings for us from the CFI group, not to be confused with the CFA Institute, on more about how VAR works and what it is. So if you're more interested in that, you can look at that article. Okay, so we can also, using, let's say, a normal density function calculator to answer questions like this. This is a really good question that inquiring minds want to know is, what's the probability that our return will be less than 0? So we could use an Excel function for this, but I just want to also show you that we could pick out any old online density function calculator to get this too. So you can see what I'm using here. I've got the URL up here. It's pretty simple. And I'm going to put in our mean of 0.8%, and I'm going to put in our standard deviation of 25%, and I want below 0. Okay, and what I find for that is that we have about a 37% probability in any given year that we're going to have a negative return. So if you're a little bit shaky on using the normal distribution to do the types of things we're doing here, I strongly recommend playing around with one of these online calculators. They're very good at illustrating what's going on here. So here's 0, and here's our probability, the area under the curve from 0 out to minus infinity, which, as you can see, to get to minus 100% here, we're going to be way out in the tail. So it's actually not so bad to use a normal distribution to model these returns. So in any event, return of 0 or less, area under the curve is 37% of the whole curve. That means 37% probability we get a return of 0 or less. Could be minus 67%. Okay, so let's keep moving. So a couple more things to get to in this chapter. The next is upside versus downside risk. In general, investors should, of course, be more concerned with downside return risks, which are losses, okay, than upside return risks. And what we want to do to ensure that we're focused on downside return risks is try to, whenever we can, measure our risk with downside left tail probabilities, and that's going to be instead of standard deviation. We can use standard deviation to measure risk, but it's better to do this type of thing. Use something like value at risk. What's the probability our return will be less than zero? Because when we're doing that, as you can see on the graph here, we're focused on the downside tail, the loss involving tail here, and that's great. That's great for a couple of reasons, because it's going to help us with any type of probability distribution for our investments. So if we have normally distributed returns like we do with the spiders and the SPY and the S&P 500, the upside and downside are symmetric. So it's not necessarily so bad in that case to use standard deviation. But here's a realistic probability distribution for a very simple portfolio. This is a portfolio that has a bunch of shares of the SPY ETF, and it's got some SPY puts in it. And so the puts have the effect of making this tail not be so attenuated out here, the loss tail. So if we were trying to measure risk with something like standard deviation, which is symmetric, it's just not going to work on something like this. And again, this is a very simple portfolio used by many mutual fund and hedge fund managers. So again, the downside risk measures that we want to consider whenever we can are things like this. The probability that our return will be less than zero, that's exactly what we saw over here, or less than some other meaningful threshold. Doesn't have to be zero, right? For companies, when they're looking at a project, they often say things like this: if we lose more than 30% on this project, we're going to go bankrupt. So they want to know what's the probability that they're going to lose 30% or more. So another one, which we just looked at, is our value at risk criteria. And that's our value X, where there's a 5% probability that our return will be less than or equal to X. And in general, any of the or less or worse measures that we looked at above. And as long as we're focused on this left side tail for risk, it's going to work with any type of probability distribution that's characterizing our returns. Okay, and the last thing that we need to talk about in this chapter is what's called volatility drag. And volatility drag is associated with multi-period risk. So far in this chapter, we've considered projects with just one investment period, 1 year, 1 month, etc. And of course, as we know, most investment projects exist over multiple compounding periods. So for example, an investment project might be we're going to put a certain amount of money into the stock market now to, in 15 years, over a 15-year period, build enough cash to pay for our child's college education. So that would be a multiple period project, okay? So when we have multiple period projects, how do we want to evaluate them? We want to consider their performance by the growth of our investment over the life of the project, not by just the average and spread of our single period returns. So let's look at an example showing how this works. So if, for example, we're investing 1,000 to cover our child's college expenses at the end of 5 years, and we have just two choices: exchange traded fund A, ETF A, or exchange traded fund B, ETF B, and we want to know which is best. So what I've got here is the returns for A, the returns for B, and the end of year annual return going out for 5 years. Okay, so if we just look at the average returns and standard deviations, we'd see that B has a higher average return than A. So if we didn't know any better, we might say, well, clearly we want to go with B because it has the higher average return. But it's also good to look at, and important to look at, the volatility of the returns measured by something like the standard deviation of returns. In this context, standard deviation is a nice thing to use. So A has a standard deviation of 0 because it's looking something like a treasury, right? It's returning 3% a year no matter what, no ifs, ands, or buts about it. Okay, so ETFA might be something that invests only in treasuries. And B, you can see it's very, very volatile, minus 15%, 1%, minus 10%, 15%, 25%. So if we take the standard deviation of that, we get 15%. So the way we want to measure performance in a case like this is to answer the question something like this. What's our pile of money at the end of 5 years in each case? So we can do that for A and we can do that for B. So the way that these two columns are working is we're starting out with $100,000, the units here are K, in each account, okay? And then at the end of 1 year, this grows to 1.03K dollars, and this one, because the return here was 15%, goes down, declines to $0.85,000. And we keep doing that every year, okay? So this is measuring the total pile of money in the account. And this is a really good thing to measure. So we've got A steadily growing, steadily growing, steadily growing, steadily growing, and we wind up with 1.16K dollars for A. And for B, notice how even though it's got a higher average return, the pile of money that we have at the end of the day is less. So the reason for that is because of what we call volatility drag. The higher the standard deviation, the more that the returns, the total return over the multi-period set of years for the investment is going to be degraded. So the higher the volatility as measured by standard deviation, or we could do it by probability of loss, it doesn't matter, the more the pile of money we wind up with at the end of the day is going to be reduced. Okay, so with that in our pocket, let's just make sure that we can all compute some of these numbers. So I'll just do a couple examples here. So how did I get this 1.03? The way it works in all cases is what we have at the end of the year is equal to what we had at the beginning of the year plus the return times the BOP balance. Okay, so what we had in the beginning of the year here was 1.0, and I'll just do a little bit of algebra on that, and I'll say 1 plus 3%. Okay, and that's how I got to my 1.03. And the same thing with our 0.77. How did we get to that? Well, in that case, our beginning of period balance was 0.86 times 1 minus, and what was our return there? 10%. You see, here's the return for that year, my 10% over here. Okay, and a good thing to measure with projects like this, you can compare the pile of money that we have at the end of the project with different investments. We can also compute something called the total project return, which is also very helpful, very useful. And the total project return is just simply what we wound up with minus what we put into the project, quantity divided by what we put into the project. So for our 11.1% return here, how did I get that? Fairly straightforward, just like in the same way we computed our annual returns for the SPY index here. I have 1.11 minus 1.00 divided by 1.00. And that clearly, that's 11.1%. Okay, so that's how volatility drag works. So if you have a long-term multi-period investment, don't be fooled by just the average annual return. You also have to think about how volatile are those returns. And if they're volatile, you're gonna have a degraded total project return because of that volatility drag. So you can also see graphically how this works. If we look on the next page, I've got a graph here of, on the x-axis, how many years have elapsed since we started investing, and on the y-axis, the pile of money that we have at any time during that investment. So you can see here that for A, even though its average annual return is less, because it's so consistent, we wind up with a bigger pile of money because we had a down year our first year for B, and then a pretty much flat year, another down year. And even though we had two very strong up years at the end, it couldn't pull our total amount of money back up to be equal to A. And so the other thing that's interesting about this is that this is path dependent. If we ran this test again and the order of the years happened to be reversed here, if we started with two very strong years for B, then it would have turned out that B did better than A. But of course, because we can't predict the future, we don't know when our volatile returns are going to be high on the upside or high on the downside. We certainly can't count on that. So figuring that out carefully is done with what's called Monte Carlo simulation, which is beyond our scope. So I think we'll just leave it there. Drag. Okay, and that's it for this chapter, and I'll look forward to seeing you soon.